Welcome to our Research and Development Tax Credit for the Life Sciences Industry webinar. KBKG was established in 1999. We have offices across the U.S. including Illinois, Pennsylvania, Arizona, Ohio, Georgia, New York, Texas, and Pasadena, California, where we are headquartered. We provide turnkey tax solutions for CPAs and businesses. Our engineers and tax experts have performed thousands of tax projects, resulting in hundreds of millions of dollars in benefits for our clients. Our team is a diverse mix of tax specialists, attorneys, and engineers from various disciplines. This combination of talent allows us to be the best at what we do and maximize results for our clients. KBKG is a preferred provider for thousands of CPAs across the country. I will now introduce our speakers, Paul McVoy and Michael Maroney. Paul McVoy is the director in KBKG's R&D tax credit consulting practice. He has more than 10 years in the public accounting, leveraging previous tax compliance and tax provision work experience to provide focused and thoughtful advice regarding the research and experimentations activities of his clients. Paul has managed research credit studies and consulted for numerous companies throughout the country, working closely with engineers, scientists, software developers, and C-suite personnel in a wide range of industries. He has successfully represented clients in tax controversy related to their research credit claims. Paul's industry experience includes, but is not limited to, software development, aerospace and defense, gaming, food and beverage, and manufacturing. Michael Maroney is a senior manager with KBKG and advises clients on tax matters related to federal and state research and development tax incentives. He has 20 years of experience working on tax reviews ranging from sophisticated multi-year claims to short-term consulting projects. He has advised numerous Fortune 500 clients across a variety of industries, including aerospace and defense, manufacturing, agriculture, pharmaceutical, communications, industrial products, consumer goods, software technology, and energy. I'd like to now turn the presentation over to our speakers.
Thank you. So here's the agenda of the items we're going to cover today on today's webinar. We'll start with the benefits of the R&D tax credit. Next, we'll discuss what's new. Then we'll provide an overview of the R&D tax credit and how to maximize the incentive's value. We'll wrap up by discussing other considerations when claiming the research credit. And then finally, I'd encourage everybody to submit questions within the chat box. And as we work through the slides, we'll try to get to as many as we can. So let's go ahead and get started. So first, we're going to talk through the benefits of the R&D tax credit. So the Section 41 credit for increasing research activities was originally enacted in 1981. At the time, it was a temporary code section and stayed as such until it was permanently extended as part of the PATH Act of 2015. The Section 41 credit is a federal statute. However, most states offer some form of the research credit, which borrows from the federal statute. And although there are billions of dollars of research credit claims every year in the United States, there's still billions of dollars that go unclaimed. And generally, this is because some CPAs or tax preparers aren't familiar with the process of claiming the credit. Or it's something that they overlook during the tax planning process. So note that the 41 credit is a general business credit, typically ranging from 6 to 10% of qualified research expenditures. As such, it provides a dollar-for-dollar reduction in taxpayers' income tax liability. Pass-through entities such as S-corps or partnerships can also claim the credit, and the benefits flow through to the individual shareholders on each shareholder's respective K-1. One other item to note is the R&D credit can be claimed for all of the open years under statute, and unused research credits can be carried back 1 year or forward for up to 20 years for federal purposes. Next, we're going to explore the recent legislative developments impacting the life sciences industry, including the enactment of the Tax Cuts and Jobs Act, the IRS LB&I Research Credit Directive, and the passage of the Protecting Americans from Tax Hikes Act, which is more commonly known as the PATH Act. So on December 22nd, President Trump signed the 2017 Tax Cuts and Jobs Act, which is the most sweeping update to the U.S. tax code in more than 30 years. So many of the provisions of the Tax Cuts and Jobs Act significantly affect the life sciences industry. Taxpayers and CPAs should analyze how their federal and state calculations may be impacted. So over the next few slides, we'll discuss provisions within the Tax Cuts and Jobs Act impacting the orphan drug credit, the repeal of the Section 199 domestic production activities deduction, and the treatment of research and experimental expenditures. So, enacted in 1983, the orphan drug tax credit provided an incentive for pharmaceutical companies to seek treatments and cures for rare diseases affecting Americans. An orphan drug is a drug developed to specifically target diseases that affect only a small percentage of the U.S. population, less than 200,000 people. Since the passage of the Orphan Drug Act, more than 480 orphan products have been approved related to the development of more effective formulations and new indications, among others. So, historically, the orphan drug credit provided a 50% credit for qualified clinical testing expenses in accordance with Section 45C. So with the new tax overhaul, the orphan drug credit has been dramatically reduced from 50% to 25% of the amount of qualified clinical testing expenses for the years beginning after December 31st, 2017. Moreover, the legislation provides taxpayers the ability to elect a reduced credit under Section 280C in lieu of reducing the allowable deductions. Some people on the call might note that this Section 280C election is consistent and available for taxpayers claiming the research credit or the credit for increasing research activities. To avoid providing a double benefit on the same expense, 280C requires a taxpayer to either reduce their deductions by the amount of the credit or to claim a reduced credit. And the reduced credit is calculated simply by multiplying the credit generated by 1 minus the top corporate tax rate. So currently that's 21%, and historically that was 35% as part of the new sweeping tax legislative change. So next we'll talk about the Section 199 deduction. And instituted in 2004, the 199 deduction, or DPAD, allowed a taxpayer to take a permanent deduction equal to 9% of the lesser of qualified production activities income or taxable income. And the deduction could not exceed 50% of W-2 wages paid by the taxpayer during the applicable year. So the passage of the Tax Cuts and Jobs Act repealed Section 199 or DPAD deduction effective for tax years beginning after December 31st, 2017. So although the DPAD deduction does not exist anymore, we can still go back and claim the 199 deduction for any open tax years beginning before 2018. So any taxpayers with production or service activities that are within the scope of 199 should consider, or at least consider when doing their tax planning in the current year, whether the Section 199 deduction for previous years is something possibly worth reviewing, because taxpayers can make those amended return claims. So life sciences companies may benefit from an increased focus on 199 planning for this year, because again, they can go back and claim that deduction and that benefit related to that deduction for the years before it was repealed. And think about the rapid speed of innovation within the life sciences sector, creating new products, solutions, and services, which could attract disproportionate investment. So we want to make sure we're claiming the benefits associated with that. So moving forward, the next thing we're going to talk about is the treatment of research and experimental expenditures under the TCJA. So the TJCA resulted in significant changes to the treatment of research and experimentation expenditures. So before tax years beginning after December 31st, 2021, taxpayers still have an option on how they want to treat these expenditures under Section 174. Currently, there's two options available. You can directly expense those expenditures when paid or incurred, or capitalize and amortize those expenditures over no less than 60 months from when the taxpayer first began to derive the benefit from the R&E. However, under the new legislation, taxpayers have fewer options and far less flexibility in treating these expenditures. For tax years beginning after December 31st, 2021, taxpayers will be required to treat research or experimental expenditures as chargeable to a capital account and amortized over 5 years. And in the case of foreign research, that would be 15 years. And Section 174 will be modified to require that all software development costs be treated as research and experimental expenditures. The law's 5-year amortization requirement could have a dramatic effect on taxpayers currently deducting their R&D expenditures under 174. Taxpayers with significant foreign research will feel an even greater impact, as the provision provides a much longer recovery period. So for taxpayers beginning after December 31st, 2021, any R&D expenditures will need to be capitalized. So it's something to keep in mind if, as a life science company, or if one of our clients is a life science company and is considering any initiatives that will have R&D expenditures into the future. And it's important to understand whether or not those expenditures or those initiatives will be foreign or domestic due to the change in legislation. So next we want to talk about the new LB&I directive, or the ASC 730 directive. So the Internal Revenue Service Large Business and International Division released guidance for taxpayers that expense R&D costs for financial statement purposes under ASC 730. And what this directive does is offer a safe harbor for clients claiming those R&D expenditures. And the safe harbor relates to the people who are directly performing R&D, or the people who are directly supporting it, and allows those companies to attach a certification statement related to those costs, and basically those costs will not be scrutinized to the extent as they may have been before. So one of the things to consider is, what sort of R&D credits are we claiming? What are the expenses or the QREs associated with those R&D claims, and how do they compare with what we're claiming for R&D on our financial statements? What is the increment that we're claiming, or if we're not claiming as much as we're claiming on the financial statements, it's something that we will want to look into for tax planning purposes, to see if there's a higher amount of credit we can claim based on this new directive. So again, one of the key things to understand is that examiners aren't going to challenge any of the QREs that are associated with the adjusted ASC 730 R&D costs for the credit year, but any additional amounts that we're claiming, because not all creditable QRE is going to fall under ASC 730 for financial statement purposes, will still be subject to a risk assessment and determined during the scope of an examination. So I keep that in mind. Additionally, this isn't as recent as the prior two examples of what's new, but the PATH Act of 2015 made three very important changes to the R&D tax credit. First and foremost, the R&D credit had been permanently extended, which allows taxpayers that have traditionally taken advantage of the credit to continue to do so. And the second big change is the R&D credit can now be used to offset a portion of payroll taxes for qualified small businesses. And lastly, qualified businesses can now use the R&D credit to offset alternative minimum tax. So we'll go through the payroll tax offset first, but effective for tax years beginning after December 31st, 2015, qualified small businesses can use up to $250,000 of research credit to offset a portion of their payroll tax. And a qualified small business is defined as a person or an entity with less than $5 million in gross receipts and no gross receipts before the 5-year period ending with the current period. So, for example, if a taxpayer wanted to make this election in 2020, the taxpayer could not have had gross receipts prior to 2016. If the taxpayer had gross receipts in 2015, they'd be ineligible for this election. One insight to remember is that the gross receipts are not required in order to make the election. So if a company has no gross receipts but does have payroll taxes and a research credit, they can make the election. Continuing, if a company is not a partnership or an S corporation, only the amount of R&D credit carry forward can be applied to offset the payroll tax, and the election starts in the first quarter after the federal return is filed. So if a taxpayer files their 2018 return in March of 2019, the election will apply to payroll taxes beginning in the second quarter of 2019. So there's a couple of bright line dates that we want to consider, especially in the life science industries where there's a lot of pre-revenue companies who are burning through a lot of cash and are generating a lot of R&D expenses, but not generating any income tax liability. And those dates are obviously going to be the date before each quarter ends. So we want to get we want to make sure we're filing before the end of March, before the end of June, before the end of September, and before the end of December, so we can take advantage of that refund as soon as possible. One thing to keep in mind is, with all of the innovation that's occurring within the life science industry, we think about augmented reality, we think about some of the specialized oncology medicine. Due to the higher volume and increasing diversity of data sources and how we can analyze those data sources, all the pricing pressures and trying to increase the access to different drugs, all of this is going to be on the backbone of technology and research and development. So for a lot of these startup companies who are coming in to disrupt the industry or trying to make their footprint within the industry, this payroll tax offset is a godsend, because now previously all the R&D that they were doing was not generating an income tax benefit, and now they're able to get a cash refund of up to $250,000 for to offset their payroll taxes that were paid. So again, moving forward, we wanted to provide an example of how the payroll tax election can help a qualified small business. And in this example, a software developer began operations in 2015. The company is comprised of 15 individuals and is not expecting any gross receipts until 2017. So in 2016, the company had 0 gross receipts, qualified wages of $2 million, resulting in R&D credits of $200,000. And they also have a payroll tax liability of $125,000. So the company will file their tax return in March, and prior to the PATH Act, this taxpayer could have claimed the research credit but would not have been able to utilize any of their credit against taxable income. But due to the changes within the PATH Act, they're able to offset the qualified portion of their payroll taxes in the second quarter. And then any of their unused credits can be carried forward in perpetuity until utilized, which is also very important. So after a company becomes profitable, if they still have an R&D credit carry forward, which is eligible to offset their payroll tax, they can use that in addition to whatever credit is generated to offset their income tax liability. So the last item we wanted to discuss was the AMT offset. And the AMT provision within the PATH Act is just as valuable to taxpayers. Prior to the PATH Act, research credits couldn't be used to offset alternative minimum tax. And as such, taxpayers in AMT were forced to carry forward their credits until they came out of that position. So eligible small businesses, which are defined as averaging less than $50 million in gross receipts for the previous 3 years, can now use the credit to offset AMT for tax years beginning after 12/31/2015. And some people on this call may recognize this provision as similar to one a previous small business provision enacted in 2010. A key insight here is that the AMT reduction is not available for publicly traded companies.
All right, so this is Michael Maroney. We're going to talk now about what is the R&D tax credit. Many of you on the call familiar with the R&D credit may recognize this as the 4-part test. This is the tax definition of research and development. So oftentimes, when reference is made to R&D or research and development, taxpayers often think about scientists in white lab coats and conducting cancer research or astrophysics. But in reality, the R&D credit tests are much broader. The definition is a broader definition and application. And provided that we meet the following tests, we have an opportunity to claim the tax credit. So in order for activities to qualify for the R&D credit, there are 4 tests that have to be met. The tests are applied at what's called a business component level. And what that means is that a business component is defined as a product, a process, technique, a software, or a formula. So the first test is called the technological in nature test. And what that simply says is that the project must fundamentally rely on principles of hard science. So this would be physics, biology, computer science, or engineering. The second test is called the permitted purpose test. Now this has to do with the objective behind the research. The objective must be to either create something new, and that means new to your company, new to the taxpayer, not new in the industry, or to take an existing product or process that the taxpayer has and intend to improve some aspect of function, performance, reliability, or quality. I say intend to improve because you can fail and still meet the permitted purpose test. So success is not mandatory when it comes to claiming the R&D credit. The third test is called the elimination of uncertainty test, and what that says is that at the outset of the project, there must be a degree of technical uncertainty related to either the appropriate design of the business component or the capability or methodology or technique for improving the business component. The fourth and final test is the process of experimentation. And what that does, that kind of works in concert with the elimination of uncertainty test. This requires that substantially all of the activities must constitute what's called a process of experimentation. And that's defined as the evaluation of different alternatives to eliminate the technical uncertainty identified at the outset of the project. So to the extent that the project meets all four parts of the test, we're able to capture the expenses that are associated with the project towards the research credit. Generally, there are three types of expenses which qualify for the R&D credit, and they are wages, supplies, and contract research. Qualified wages are generally defined as the qualified portion of an employee's W-2 Box 1 amount. There are three levels of qualifying activities. The primary level would be the individuals that are engaged in qualified research. These are the individuals that are working directly on the project. And then from there, taxpayers can capture one level directly above and one level directly below. One level above would be the individuals that are directly supervising those personnel, and one level below would be the individuals directly supporting the personnel. Now, qualified supplies are items that are used and consumed in the research process. For example, materials used in prototype formulations or ingredients for new drugs. Supplies cannot be capital in nature, so you can't qualify things like land, machinery, and equipment. And then in addition to that, you can't claim general and administrative expenses such as travel, meals and entertainment, and telephone expenses. And then finally, the third qualified expense is contract research. And these are defined as 65% of the payments that are made to third parties on the taxpayer's behalf for purposes of qualifying research. So in order for these payments to qualify, the payment to those contractors cannot be contingent upon the successful completion of the prototype or of the development. Therefore, qualified contractors are paid regardless of whether or not they are successful. Additionally, the credit is a domestic credit, and therefore the contract work must be performed in the United States in order to qualify. So the credit is the sum of 20% of the company's QREs over a base amount, plus 20% of basic research payments. These are payments that are made to tax-exempt organizations performing research on your behalf. And they are, think of like universities, scientific research organizations, those kinds of organizations. Plus 20% of payments that are made to energy research consortia. And what these are tax-exempt organizations as well performing energy research, and they're typically funded by a small group of taxpayers with an interest in the results of the research. Now, the credit is based on the qualifying activities conducted by the company or those the company pays to conduct research on its behalf. It's primarily a wage-based credit. U.S. Treasury reports that on average, 75% of the credit is generated from employee wages, the qualified nature of which meets the four-part test. Or for internal use software development, there's an additional 3 tests that must be met. And then finally, the credit is incremental in nature. So QREs in the credit year must exceed a minimum base amount for a credit to be calculated, and the base amount is calculated each year, either as a function of gross receipts or of the prior year's QREs. So now that we know what qualifies, it's important to understand who qualifies. We've alluded to this before with direct supervision and support, but there are three levels of qualifying activities. So the primary level would be those that are engaged directly in qualified research. Those are the ones working directly on the project. And then we can capture the direct supervision of that activity as well as the direct support of that activity. Generally speaking, any payments that are made to third parties for the conduct of research are eligible to generate research credits. It's important to note payments for contract research are subject to a statutory reduction, and this reduction is 35%, but may vary depending on the type of organization conducting the qualified research for the taxpayer. So let's talk a little bit about qualified activities. Qualified activities are applied at the business component level, which we have defined as a product, a process, a software, technique, or formula. Examples of qualifying activities can fall under several categories, and this list is by no means all-inclusive, but some qualified activities occur in the design stage of a project, including specification design, technical design work, CAD work, modeling, computer modeling and analysis. It can happen at the prototype level, prototype development, including the design, construction, and testing of the product. And then finally, testing and experimentation, including computer modeling and simulation, prototype testing, and field tests. As we've mentioned before, success is not required in order for the project to qualify. In fact, when a development is unsuccessful from a technical perspective, it makes the technical uncertainties associated with that project that much more obvious. So the life science industry is exploding with qualified activity. So the following serves as some examples of the most common qualified activities. So developing new or improved drugs, biologics, or medical devices. There's also new or improved formulations for the purpose of treating a new class of patients. There are process improvement initiatives for the purpose of increasing shelf life. There are scaling up manufacturing and packaging trials, or prototype product to full-scale production batches. There's experimenting with new uses for existing drugs, and experimenting with new designs or manufacturing techniques for new production lines. There's also developing new technology or processes to comply with new or more stringent government regulations, and experimenting with new or alternative materials that may result in a change as a result of a change in a supplier. So developing new or improved packaging to increase safety or meet USP requirements. The Phase 4 clinical study activities involving a patient population not previously studied may also qualify. And more qualifying activities include designing special tooling or fixtures for medical devices that can qualify, manufacturing clinical trial lots and improving the drug delivery systems can also qualify. And then finally, experimenting with 3D bioprinting. For example, developing a bioprinted kidney may also qualify. All right, so let's talk a little bit about non-qualified activities. So because this is a domestic credit, any activities that take place outside of the United States are considered non-qualifying activity. There's also any adaptation of an existing business component. That's where you take an existing product or process, tweak it a little bit, make a little minor improvement to it, and call it R&D. The second item there, or the third bullet point, I guess, is duplication or reverse engineering of an existing business component is not allowed. Activities that are involve the social sciences or humanities. Think of like sociology, psychology, behavioral sciences, market type research is not technological in nature. It doesn't rely on the hard sciences. And then studies related to efficiencies or management operations or profitability. Certainly there could be uncertainties in those areas, whether or not the public is going to accept the product that you're attempting to develop, or whether you can turn a profit on it. Those are definitely uncertainties. They're just not technical uncertainties. And then any routine data collection or routine or ordinary QA testing is non-qualified activity. And then if research, and this is an important bullet point, if research is considered funded, what has to happen here for the taxpayer to claim the credit is they must retain at least shared rights to the technology under development, which means that whoever is paying them to create this product, if it's a customer relationship, the taxpayer must have no restrictions placed on the use of that technology, even if it's to make the same thing for a competitor. But the taxpayer must also be deemed financially at risk for the development. And so what that means, if it's deemed funded when the taxpayer is paid by a customer under a time and materials terms, because they are paid whether they are successful or not, the taxpayer is. It's deemed funded research if a taxpayer pays its contractors to perform research under firm fixed price terms. So it's very important if your client is in the business of customizing a product or developing a product under a contract for a third party, that you look at the contract and you ensure that they have at least shared rights to the technology and financial risk in the development. Now, the credit is based on the qualifying activities that are conducted by the company or those the company pays to do the work on its behalf. As we've said, it's primarily a wage-based credit, and there are two federal calculation methods that are available: the regular credit or traditional method, and the alternative simplified credit method. Both methods require calculating a base amount which a company's current R&D expenses must exceed in order to claim the credit at the federal level. So for the regular credit, this base period focuses on years 1984 to 1988, or if the company was not around during that time, the base period consists of activity occurring after 1993. Now, for the alternative simplified credit, the base amount involves only the 3 prior years' expenses. Therefore, it's called the simplified credit method. There's less historical documentation and less numbers you have to work with. Taxpayers may elect on an originally filed return which method it wants to follow, but once that election is made, the company is stuck with that method for that tax year. If the taxpayer wishes to change its calculation method on a future tax year, it must be made on that year's original return. However, if you're going back and amending a prior year return to claim the credit for the first time, either method may be used. So for the traditional credit, there are 4 items that you need to calculate in order to claim the credit or calculate the credit. One is your qualified research expenses, or QREs. The second item is the average annual gross receipts for the 4 prior years. And the third item you need to do is to calculate what's called a fixed base percentage. This is defined as the ratio of aggregate QREs over aggregate gross receipts for a specific period of time. And the maximum fixed base percentage allowed is 16%. The final item you need to do is to determine the base amount. Now, to do this, you have to calculate two numbers and compare them. First, you multiply your average annual gross receipts by your fixed base percentage. Then you take 50% of your current year QREs. Whichever amount is greater is your base amount. This is the amount that your current year QREs must exceed in order to get a credit. And then the credit then is applied to this amount, the credit rate is applied in order to arrive at your credit. Now, the alternative simplified credit only includes two components. So whereas the regular credit required a fixed base percentage calculation and average annual gross receipts, the ASC only requires QREs for both the credit year and the 3 prior years. The base amount is calculated by simply taking 50% of the average QREs for the 3 prior years, and then subtracting the base amount from the current year QREs and multiplying by the 14% credit rate is the amount of the ASC credit for the current period. So the ASC credit is available for tax years ending after December 31st, 2006. And the base, as we said, the ASC is calculated by applying a 14% credit rate to the current year QREs that exceed a base amount. One thing to note is that if you don't have any if you don't have all 3 prior years QREs, then the ASC credit is calculated by taking 6% of your current year QREs. And then with recent legislation back, I guess it was back in 2013, 2014, you can now amend into the alternative simplified credit method. Whereas prior to that, if you wanted to go back and amend a return, you had to use the only method that was available, and that was the traditional method. So the base amount is the prior 3 tax periods. As such, a major benefit to using the ASC method is that it requires much less historical documentation. So it's a great option for older companies who may not have records or the appetite to support their regular research credit base period or coming up with that fixed base percentage. Furthermore, companies with large gross receipts, because gross receipts, the larger your gross receipts, that increases your base amount and that reduces your credit. So if you have large gross receipts or a complex corporate structure where you have a lot of entities, the ASC calculation makes it a much simpler calculation. All right, so let's talk a little bit about maximizing value when it comes to the R&D credit. So here are a few things to consider to maximize the value of the R&D credit, particularly in the life sciences industry. First, consider more than just the salary. Things like bonuses or exercised stock options are taxable income and may be included in the qualified wage amounts. Things like I didn't mention it on the wage slide earlier, but if you're in a partnership and you have a partnership or shareholders in an S corp, the benefit flows through to their individual K1s, but also included on their K1s is their income that's subject to self-employment tax, and that number can be significant, and that is their wage amount that can be applied to their percentage of R&D level of activity that they're doing, and can become their qualified wage at whatever ratio they are involved with R&D. So look into that. Also, if it's a single member LLC or a sole proprietorship, we're looking at the Schedule C, Box 31, I believe it is, which is the net income or loss. So in the net income is that individual's wage. And so again, that can be a significant number depending on the circumstances. So don't just look at A company and its employees' W-2 Box 1 wages also look at bonuses and stock options for owners and so forth. The second item is collaboration agreements. These type of agreements often require a payment upon successful completion of technical milestones, which could satisfy the taxpayer's risk requirement that we talked about earlier when it comes to risk and rights. And it can qualify these agreements in the taxpayer's favor. The next item is looking at employees providing direct supervision or direct support. They need not meet the 4-part test in order to qualify. The caveat there, though, is that the activity that they are directly supervising or directly supporting must meet the 4-part test. So there's a distinction there to be made. And then although foreign activity, we just got done talking about that with the U.S.-based contractors, although foreign activity is not generally qualified research, if a clinical study population may only be found outside of the United States, then expenses associated with that activity could qualify for the credit. And of course, that'll be on a case-by-case basis, have to look at the facts and circumstances, but that is an interesting departure from the norm, and specifically related to the life sciences industry. Even though, the next bullet point, even though high-level executives may be considered oftentimes too far removed from the research, it is possible for them, particularly in smaller, flatter organizations, to be more hands-on R&D and even directly supervise trials, prototype development, and testing. And then we talk about intragroup transactions, transactions between related parties within the same organization or same controlled group can qualify. For example, employees loaned from one company to work on another company's projects. Also, job titles. Job titles can be used as a good starting point for your qualification exercise, but don't let the job title steer you away. In the end, the job title doesn't matter. The qualified activity does. And then again, if you're paid only upon successfully completing a technical milestone, the risk requirement is met in order to claim the credit. And then as far as non-traditional R&D cost centers, they may be a good place to look for additional qualified research activities. Examples could include your sales department, your manufacturing, your information services or IT, quality assurance and quality control departments. And then Phase 4 activities. Some Phase 4 activities may qualify for the credit. For example, if you're studying a population that you had not previously considered, maybe for like a clinical trial, then some Phase 4 activities can qualify for the credit. Now, there are some other considerations I want to talk about as well, more audit-related considerations. Here are some IRS audit tools and strategies to consider to substantiate the R&D credits claimed. The first is that Treasury has an audit technique guide that is publicly available. It's generally it's published generally for all R&D credit studies. But there also are a couple that are just for just for the life sciences or pharmaceutical type industries. So there is an LB&I directive for the pharmaceutical industry, as well as a coordinated issue paper for biotech and pharmaceutical. They all pretty much do the same thing. They provide guidance to their examiners as to what to look for as far as qualified research, and what departments and what stages of development to look for to maybe disqualify certain activities. There's judicial and administrative guidance out there, court cases, and regulations and so forth. Also, just from an experience standpoint, the IRS continues to use to target the use of estimates. Even though the courts have ruled time and again that credible estimates may be used to determine qualified expenses both in the credit year and in the base years, oral testimony also has been deemed credible. Acceptable in a court of law, so long as it is credible, and that oral testimony can also be relied upon to determine qualified activities surrounding the business components. That said, collecting documentation to support the R&D activities as well as the expenses associated with them and the development, it can go a long way in satisfying the taxing authorities both at federal and state level. The key is that more relevant documentation you have, the better. So it's not just the volume of documentation, it's how relevant is the documentation, establishing the nexus between the activity that's taking place, the individuals that are doing the activity, the expenses, the expense of those individuals, and the business component is paramount. So again, the key to this nexus is substantiating documentation, and the regulations call it contemporaneous documentation. It's documentation not created after the fact, but during the development process is the most powerful and relevant documentation. So with that, I provided this last slide just showing examples of what that contemporaneous documentation could look like. So here we have 3 general stages of development and the documentation that would be generated as part of that phase of the project. So again, this is not an all-inclusive list, but just to get you thinking in terms of what does my client have, what do I have that I could produce that was generated with the development, alongside the development, that I could keep in case of an audit of the R&D claims that I'm claiming.